Okay, before we jump in today for the Applied Series subscribers, the next live Q&A sessions are May 28th. The first one is noon to 1:30 Eastern Time. The next one is 9 to 10:30 Eastern Time. I did this on the last Friday of April. The first session went very well. The second session, no one showed up, which I thought was rather odd. And then I was receiving comments that, hey, I showed up and there was nobody there. The next morning, I was getting error messages from Vimeo. There seemed to have been a problem that anybody who was doing a live event could not see anyone attending that event. So from our perspective, there's no one here. But from your perspective, you were there. Just for some reason, I wasn't getting any, it wasn't coming through. I wasn't seeing, the stats saying how many people were on, said 0. There was nothing in the chat, like nothing at all. So I think it was a Vimeo error because it seemed odd. I've never had that issue where I've had a live session and no one shows up. I've never had that. So it seemed rather odd. I thought, well, maybe the first session was so good, nobody needed the second session, but again, that seems odd. So hopefully the issue is cleared up this time. There will be two time sessions. That's May 28th. That's next Sunday. I know it's the U.S. long weekend. This weekend is the Canadian long weekend. I know it's the U.S. long weekend, so attendance might be lower than normal, but I'm going to do them anyways. For CFA, if you were waiting to register for 2024, they are now available. As of May 16th, they went live for Level 1 and Level 3. So you can see the Level 1, Level 2, Level 3 packages. If you're thinking, oh, Level 2 already? You can register for or subscribe for Level 1 or Level 3. That's fine. But you click on Level 2, you will see down here, you cannot buy this, available August 15th. It's just IT says there's no point in getting everything ready for 2024 unless you're just going to do everything. The algorithm will do everything. It's just more work to exclude Level 2. So let's put Level 2 in, and then we will just block it. So you actually can't buy till August 15th. But Level 1, because there is no Level 2 exam till May, but Level 1 and Level 3 for the February 2024 exam is live. Well, let's have a look at rates. The story continues to be the debt ceiling. Friday, after the market closed, we found out that talks in Washington broke down, but that they were going to be at it Saturday. But Saturday didn't reveal very much. And Sunday, the latest update I have on this is Biden saying the ask from the Republican sides is unacceptable. So that he's having a one-on-one with McCarthy today to see if they can get anywhere. But June 1st is 10 days away. And from the Republicans' point of view, this won't cost them any political capital. So why not milk the free coverage, the free campaign coverage you're going to get for the next 10 days and see what you can do to cripple Biden in the next election? Party before country, right? So I don't know if something will get done. It seems to me inconceivable that rational minds, no matter what their goal is, and no matter what their personal ambition is, that there is a point where you say, well, look, it's not worth destroying all of that for my personal ambition. It cannot possibly be worth it. That rational minds would step in at the last minute. So I sort of still think this is a lot of theater, a lot of political posturing, but I don't know anymore, because you have an element in government today, and not just in the US, Canada's got its own element too, an element that just seems to be detached from common sense. So it'll be interesting. Anyways, have a look at the money market rates. Your 1 month is at 5.62. In fact, they've all increased all the way up to the 6 month, even the 1 year. Look at that, 27 basis points, 20. I think this is reflecting more of a higher for longer stance. No rate cuts. I think that's starting to get priced into the 6 month and the 1 year. The 1 month down 17. I don't know that there's a lot of information in there. The 2 month up 40. And that is all just positioning, deciding that I don't want to be in front of this date, but I want to be after this date, and where they're going to put money. There is an estimate that once the debt ceiling is removed, the second half of 2023 will have about $1.4 trillion in T-bill issuance. And I heard an argument that, well, if you have that much T-bill issuance, it's going to depress price and push up yields, that all these yields are going to continue to increase. I don't think so. I think the movements, these radical movements you're seeing in these rates are more a reflection of the uncertainty of the date on which you're going to get paid. Not an uncertainty on whether you're going to get paid, but an uncertainty on the date on which you're going to get paid. And if you have obligations that you have to meet, and you're trying to cash match those obligations by buying short-term bills, then you have to say, look, what if this doesn't work out? I can't possibly be in this T-bill. But once this is cleared up and all of that issuance comes, I believe the demand is out there to absorb that supply, and I think that rates would actually drop on the T-bill rate, because there is a lot of money that simply just doesn't want to be in those securities right now, that is trying to find another home. Capital market rates all went up this week as well, so we can see not so much on the capital market inversion. The 2 to 10 year actually dropped another 6 basis points, now negative 58. The more critical one is the 3 month to 10 year. Inverted 159, so it increased by 20 basis points over the week. 189 still continues to be the deepest part of that inversion. And I think you can pretty much put the blame for all of that, if you want to call it blame, for the Fed speakers. Now, there was a mix between those who think that we should be on hold and those who think another rate increase is appropriate. Not a single one said a rate cut would be appropriate. Not a single one said that rate cuts would be appropriate anytime this year. You're into 2024, into the end of 2024, before they would consider a rate cut. And I think the market is finally getting that message, because the capital market yields are all going up. When we look at the Fed funds futures curve, it is flattening out even more. And we're not done with the Fed speak. Monday, leading off, you got Bullard, Barkin, and Bostic, the three Bs. Tuesday is Logan, Thursday is Collins. So you got 5 more speakers next week. And we end the week with PCE, which is the Fed's preferred gauge for inflation. Balance sheet continues to run off, at least in the open market account. And 30 billion gone, down to 7.666 billion. Treasuries rolled off, and mortgage-backed securities. And the Fed balance sheet is down 47 billion. 30 billion was the SOMA, so 17 billion was extra borrowing that is not there. The 18-month forward minus the current 3-month is inverted 189 versus 220. So the money market curve inversions and the capital market curve inversions are all steepening. We say that a curve steepens when it does this kind of thing, but if it's inverted, then a curve steepening is just less inversion, right? So they're all steepening. The CDSs, 5-year U.S. Treasury, 5-year CDS, 65.66 basis points. Last week was 65.34. And the 1-year CDS, 149.2 versus 150.4 last week. Basically unchanged over the week. Not getting worse, but not getting better. Money market funds continue to draw money. Another 13.56 billion. They increased. Retail increased by another 14 billion. Institutions dropped by 616 million, 0.616 billion. Government funds increased another 9.55 billion. Next, FOMC, June 14th, 24 days away. Bank of Canada is, I think, a week before that, June 7th, which is 17 days away. We get the minutes from the last meeting in 3 days. And I think that is where we're going to see what kind of discussion they had about the pause. And if there's any indication that June seems to be the date they're thinking about for a pause. Although I will say that the last CPI was not promising on a month-over-month basis with almost every single category. Same with PPI, almost every single category increasing in April over March. I think before the June 14th FOMC, I think there is one more CPI report. So we have 3 big reports before June 14th that will give us some indication. We have PCE at the end of this week. You have the jobs report at the very beginning of June, which is the following Friday. And then I think you get the CPI on the Tuesday, on the 13th. So they'll have that available. And I believe the JOLTS report is available before then as well. Here you are, PCE, 5 days away. The odds for a rate hike, 25 basis points, have increased, if ever so little. They still have increased, 17.4, up from 15.5. That puts the weight still on a pause, 0 basis points, 82%. For the end of December, not much has changed here. For the ranges, or for the upper part of the range, 4.5 to 5.5, there's still not more than 1% on the 5.5, which is one more rate increase from where we are, so not much probability here. The weight of the probability seems to still be at least 1 to 2 rate cuts. I think that is going to change over time. We'll talk about the lag effects at the bottom of the screen here. The New York Fed effective federal funds rate 5.08%. The reverse repo facility still in use, over $2 trillion, up another $47 billion over the week. I'm curious what will happen to this if you do get a resolution to the debt ceiling, and there is a lot of bill issuance right away, and rates are in the range, because this is going out at 5.05. Which is the SOFR rate, 5.05. So if the front end of the curve, the 30-day and the 60-day, offer a yield higher than 5.05, I wonder if this would finally break $2 trillion on the downside. Because this money is available. I mean, this is where it's going because it's getting that rate with no uncertainty at all, and it's getting 1 day. So if it can find some good supply of T-bills in the market where it can do better, I wonder if this money would find its way into that. Let's talk about where we are here. Williams made a pretty bold statement. The era of naturally low interest rates has ended. When we talk about lags here, Jefferson last week said 1 year is not enough to see the effect on demand. And that got me thinking, 1 year is not enough to see the effect on demand. So we have heard them say in the minutes that they think a pause might be appropriate to assess the effect of the lag of all of the rate increases. And they keep mentioning that the lag is anywhere from 12 to 18 months. So I did some searching on Google Scholar to see if I could find anything that can confirm or deny that. And it all seems to be fairly consistent in the sense that they are variable, that some rate increases operate right away. That is your floating rate debt, which most commercial real estate is floating rate debt. Credit cards, mortgage rates, car loans, things like that. But that is for the marginal, when we talk about bank lending rates, that's for the marginal borrower. Not for the existing borrower who had fixed rate. And it's also not for commercial real estate firms, companies that own commercial real estate, that when they originally put their loans in place, use interest rate swaps so that they still effectively have a low interest rate even though they have a floating rate. because they would enter into a pay fixed, receive floating swap because they have to pay a floating rate. And when the curve was very low and very flat, you had a 10-year well under 2%, the fixed rate was very low. So even looking at some mortgage REITs, you look at the fixed for floating swaps that they're in, and the rate is really low. So we have to recognize that there is some lag due to the existence of swaps and fixed rate debt. In the US, most homeowners, have 30-year fixed rate mortgages. Well, combine this with Williams, the era of naturally low interest rates have ended. We're not going to see sub 3% mortgages for quite some time if we accept that the people in the room that are voting on where rates are going are saying things like this. We pretty much know how Williams is thinking about rates. So if you have a 30-year fixed rate mortgage at 3% or 2.9%, you're not going to just cash in, sell your home, and upgrade to something else if you're going to have to take on a mortgage at 6.5%. And we're hearing that is, one of the things that's contributing to the undersupply of housing right now is that anybody sitting on preferable financing is not moving. So those interest rate hikes, you could say, have had no effect on those homeowners. The interest rate hikes have had no effect on those companies that had interest rate swaps in place. So there is a lag, but the literature is very cagey about how long the lag is, and they're more of estimates that some things happen for the marginal consumer or the marginal participant in the economy immediately. Some things play out over a quarter, and some things do take longer, and the 12 to 18 month amount was there. So I'm going to use a lag of 12 months here. And if we go back 12 months, the upper end of the rate was 1%. So the range was 0.75 to 1. And we're at 5.25, or the range being 5 to 5.25. And I think we have to think about two effects here. You have the visible effect of an interest rate increase that we can all see. And we know exactly what date they happened on. And the market responded to those interest rate increases. But then there's the effect of those interest rate increases. And when the market reacts to the interest rate increase, it's pricing in the effect in the future. That makes perfect sense. But it seems to want to rally back up because the belief is that, well, we're on pause now. It's behind us. Well, it's not really behind us if we consider the lag. Let's just draw a straight line down to the black line is your lag, and the red line is your rate hike. If you draw a straight line down and you think about the lag effect being 12 to 18 months, I'm just going to use the 12. What lies in front of us is the effect of, 425 basis points of rate hikes. Because, again, a year ago, the range was 75 to 1. And if it does work with a lag, let's say a 12-month lag, then what lies ahead of us for the next 12 months is the effect of 425 basis points of rate hikes. Because as some fixed rate debt ends and rolls over, it's going to roll over at a higher fixed rate. As swaps end, and if you look at the 10Ks of companies that have swaps, you can see some of them are ending in 2023, some end in 2024. So you had debt that you took out in 2018, you put an interest rate swap in, well, those swaps expire in 2023. So they'll all start to expire over the next few years, and they'll all reset higher. Some companies are already seeing that. One Canadian high yield fund, Northview High Yield Fund, if you looked at its stock, its ticker is NHF.UN. It dropped, I think, 25-30% because on its last earnings, it showed increase in NOI, nice growth rate in NOI, 9.2%, but that the increase in their floating rate debt completely absorbed that and pushed them into a loss. And they also stated that they are not sure what they're going to do with that they're pursuing a whole bunch of different courses of action, including flipping it into fixed rate, doing a recapitalization, potentially issuing more equity, or even if the equity will still have any value, because it was a high yield fund that used in their capital structure 70% debt. Now, I was in that for a while, but you'll recall about a month and a half ago I said that I'm out of all my REITs. And when I saw this thing plunge, I don't believe in God, but I looked up and I said, thank God. Because I had, I think, 40,000 shares of that before I exited. So I would have been down significantly on that. But I'm starting to see it hit in certain REITs already. And we'll look at something interesting in REITs shortly, because we have to also consider, this was 70% debt. You have to also consider the property value. Property value is decreased over the same period of time. So if you calculate the debt as a percentage of the, not the book value of the assets, but the market value of the assets, it's going to be a lot higher than 70%. The question is, who's going to step in and provide that debt? Maybe you have private debt lenders, but that's not going to be cheap. So I think that this company has some pain ahead of it. So if we accept the lags, we have in front of us the effect of 425 basis points of hiking left, because the Fed does keep saying these work with long and variable lags. So either we believe that they work with lags, or we do not believe that they work with lags. So you got a bit of a decision tree here. The effective hikes are still ahead of us, or the effective hikes are fully absorbed. And if you think the effective hikes are still ahead of you, then you have to say, well, what is this going to do? We've only seen the trigger being pulled. We haven't seen the bullet hit, right? So that's a pretty big headwind. If, on the other hand, you say, well, okay, long and variable, every company has adjusted to them. The effect isn't really there. The effect has already happened. Lots of companies have rationalized their workforce. They've laid people off. Companies a whole bunch of companies are issuing investment grade debt now ahead of whatever is likely to come. Balance sheets are strong. There's lots of cash out there. It's going to be different this time. So if you believe the effective hikes have been fully absorbed, you have to accept that the neutral rate is greater than 5%, because you have a robust economy in terms of jobs. You've had fairly good earnings. The anticipation was for negative 6%. We came in at negative 3%, better than expected. The worst of the worst didn't show up. They weren't great, but they weren't bad. So you have a fairly robust jobs market. You have extremely strong wage gains, and you have earnings that seem to be holding up. Where's the cry to start cutting rates? Where is that? All right. So that you'll have to accept that the neutral rate is greater than 5%, and you must accept that there are going to be no rate cuts, because the economy is clearly not broken if you believe that all those rate hikes have now been absorbed, and what we're seeing in the economy is the full effect of all those rate hikes. Then you must accept what Williams said: the era of naturally low interest rates have ended. It is the conclusion you must come to. And if that's the case, in all of your models, you must raise the cost of capital. You must raise the cost of debt permanently, because that's where it is. And equity is riskier than debt. It's lower in the capital structure. You got to put the risk premium on top of that for the equity that you have. And the greater the proportion of debt in your capital structure, the higher the risk premium is going to be for equity. If you don't believe me, have a look at these guys. If that's the case, then the future cash flows have to decrease. The present value of those future cash flows have to decrease. And we are not in a high growth environment. We're in a low growth environment. So no matter which path I take, there are 425 basis points of effect still lying ahead, or there are no effects lying ahead, and this is where we are. This is the new normal. 5 to 6% interest rates. That's the new normal. And if that's the case, then the present value of all those cash flows have to decrease. No matter which pathway I take, I don't see a move on equity indexes to the upside in any real significant way that is sustainable. Okay, real yields have all increased again 2 weeks in a row. Quite significantly, 23 on the 5-year, 19 on the 7-year, 18 on the 10-year. The increase in real yields is probably the most direct thing we could look at in terms of the discount rate for future cash flows. That is a negative for future cash flows, yet the S&P just said, we don't care. It's temporary. Fed's going to pivot. Fed's going to pivot. They're going to cut. They're going to start cutting. They're going to start cutting in July. That's what they're going to do. TLT took a bath, right? Down 3.04%. I had rolled my May 104s into June. Good thing I did that, because if not, they would have been assigned to me. I'm underwater on them now, but I'm okay with that. IVP seems to have returned. 13-week IVP, 38th percentile, up from the 8th percentile. I did add to my 104 puts. I added at 325. I am looking at the March 2024 105 calls. As of Friday closing, they were sitting between 585 and 610. If we have any downward movement on TLT, I won't add any more puts. I will add the March 105 calls. Why am I doing this? The higher for longer scenario simply means that you're going to keep the economy in a, I don't want to say fragile, but fragile enough position such that an exogenous shock would take it down. And exogenous shocks happen all the time. When they do happen, usually the economy is in a condition such that it can absorb that shock. Where we are right now, I don't think so. Also, if we do accept the lag argument, of which the literature seems to say, yes, there is a lag, on some part of the economy, especially when you start looking at all the companies that use swaps and fixed rate debt that's going to expire, there is a lag effect that 425 basis points are still to come. I'm still going to hold a long duration play, because if there is a recession and the Fed is going to cut, they're not going to cut small, they're going to cut rather large. That's sort of what that trade is for. I don't mind adding to my calls because, as you know, I try to work off the price of the calls. I've completely worked off the price of the January 110 calls that I have. I've completely worked them off. That trade is in a position such that I cannot lose at this point on those calls. I cannot lose because I have more than worked off the price. So I can use some of the house's money to buy the calls for March, which I'm going to do. Let's look at Fed funds futures. The bottoming out is now all the way in August, 94.87 at 5.13. So the idea of a rate cut in July is gone. That's over with. Last week it was June and July, bottoming out at 94.915 for a rate of 5.085. So it has moved forward 1 month, and the implied rate is higher by 4.5 basis points. And I think that as each week goes by, we'll start to see eventually it move into this. So it'll start going like this, and eventually we will get a flat curve that by 12 months from now, if you still kept the May, June, July, and August on here, you'd probably have a straight line. Going into December, last week was 95.51 for a rate of 4.49, 95.27 now for a rate of 4.73. In other words, the implied rate is 24 basis points higher. So the market has taken at least one rate cut off the table, all just in 1 week. With the Fed speak that we had, one rate cut has now just been completely priced out. And going from August to December is still implying 40 basis points lower on rates. So there's still one and a half rate cuts in there. Going to March of 2024, 95.63, which is 4.37. Last week it was 4.055. on that one. When I say that this has dropped by 40 basis points, I was looking at the purple 59.5 going, okay, why did I write that there? Why did I write it? It was because that was what implied last week, that there'd be 60 basis points of cuts. Now there's 40 basis points of cuts. December 24 to December 23, this is going into 2024, 3.25 and 4.58. Last week was 289 and 429. We can see they've both increased. Sort of in line with what Williams was saying, is that if you think we're going back to these low rates, think again, that era is gone. That's another 133 basis point cut over 2024. Last week it was 140, so it's finding its way into 2024 as well, and I think it'll continue to do that week by week. The real yields, at some point, analysts are going to have to change their estimate of cost of capital. They can't say we're looking past this, thinking that, well, we're going to go back to negative real rates, so we're looking past this. They're going to have to increase their cost of capital, and when they do that, you're going to start to get a wave of price downgrades. The longer we go on with the belief that rates will be at this level, higher for longer, the less likely it makes sense to say, well, we're looking past this, right? Unless you get a recession. Break-even rates have all increased as well, but still, if you say they're well anchored, they're fairly well anchored to the 2%. OAS corporate spreads all decreased for the week. Look at issuance. This is U.S. investment grade bond issuance. This is from PitchBook, and this is May. The first three bars over here, 122 billion for May. Issuance to date for high yield, 11.5. By the way, that beats last May handily. High yield, 11.5 billion month to date for May. Last May was only 4 billion. So debt issuance just keeps coming. There is an appetite for debt issuance for both investment grade and high yield. Look at this one line here. When I saw this, nothing in this week, I thought, well, maybe the data's not, the data didn't show up in the chart. But this was a week where there were no issuance. That was the SBB failure, and nothing came to market that week because, well, I guess nobody wanted to buy anything. One thing that'll be interesting to start looking at are SASB bonds, commercial-backed security, commercial mortgage-backed securities. SASB is single asset, single borrower. In other words, you have one building, right? Usually it's what's considered a trophy building. You have only one building, and all the bonds are on that single building, single asset, single borrower. There is 45 billion of these particular bonds with a final maturity in 23 to 2024. And these were basically created over the last decade. They were created at peak valuations and low interest rates. And valuations from the peak have the potential during this period of time, given where rates are now, of being down almost 50%. The valuations being down almost 50%. There are some buildings that I've seen that were originally bought for $1 billion, sold for $369 million because the owners said, well, there's no point in paying the debt. That's 70% that's gone. Trophy buildings usually hold up their value fairly well, but there's an estimate that they could drop up to 50%, and interest rates are going to reset 300 to 400 basis points. So this is not on the books of any banks. These are commercial mortgage-backed securities. They're on the books of the banks to the extent that the securities that banks hold might include a commercial mortgage-backed security. And if we look at the 1 year, 2 year, 3 year treasuries with respect to the 1 to 3 year U.S. high-grade category, 42 basis point spread from the 1 year to the IG, 114 on the 2 year, 144 on the 3. And if we weight them equally, you get a spread of 100 basis points, which is fairly close to the 102 that they have. Last week was 98.33. The week before was 91.66. So the weighted average spread seems to be increasing, giving more compensation to moving into investment grade from treasuries. I don't know if that all of this is so close to the front end. I don't know if that is the debt ceiling is having any effect on any of those. So there is some distortion perhaps going on. We'll have to wait and see what happens after, not just after the debt ceiling is lifted, if it is lifted, but several, I think a quarter to a quarter and a half after that, to have the effect of all the supply wear its way through the market. Given the week that we had, you'd think that mortgage rates would be higher. They're up 4 basis points. The Thursday over Thursday 10-year Treasury is up 26 basis points. The 30-year fixed rate mortgage is up 4 basis points. So you had a spread decrease of 22 basis points. Agency eked out a small gain, 0.44% for the week. Annaly 2.24. Arbor pulled back 0.97. IYR. This is where we should see the effect of higher rates, of higher real rates. And we're really starting to see that now. Negative 1.91. You'll recall that I opened up January 24, $80 synthetic short position on IYR. So in drawing out a little outcome tree, either you have rates that are higher for longer, or you're going to get rate cuts. If you got rates higher for longer, IYR is going to have to drop, because the idea behind REITs is that they have very predictable cash flows because they have leases in place. So their cash flows are far more predictable than any company that sells a product. That makes their cash flows very bond-like, so they should react like a bond. IYR would drop, but the price of bonds would drop, which means yields would increase. My duration trade would not work out very well here, but my short IYR would work out well here. And if you get rate cuts without a recession, well, then IYR would probably go up and bonds would go up. So my duration trade would play out well here, but my IYR would not work out well here. I place very low probability on rate cuts, that if you are getting rate cuts, there's something wrong in the economy. And if there's something wrong in the economy, keep in mind, we have NOI in the numerator for our cash flow. That would hurt NOI, so you would actually have IYR dropping while bond prices increase. So my duration trade would work out and my IYR would work out in a recession. So higher for longer makes sense to be short IYR, but calls into question what's going to happen to the duration trade. But I hope what you're seeing here is the way that I've got my portfolio structured, is that I don't have all of my bets on one side of a coin toss. So if I were saying we're going to rally, I don't have 100% of my portfolio positioned for a rally, because what if we don't get it? Then I got 100% of my portfolio that's killing me. But I think that we have probably a recession that's going to show up with some exogenous shock. But I don't have 100% of my portfolio positioned for that, because what if we don't get that? So you try to find positions that offset each other, that get you into a sort of a neutral position. And being short IYR sort of minimizes the effect of duration working against me, because if we do have higher rates for longer, the higher bond prices, the higher yields go, because really bond prices are a series of cash flows, PMT, right? And you're discounting each of those by a discount rate. Well, that is the discount rate we can see. So you're going to get lower prices. The equity that's closest to a bond is a REIT, because of its cash flow predictability. It is very bond-like in its cash flows. It will respond the same way. So I can offset some of the risk of being long duration by being short something that has a duration quality to it, which is the IYR. Look at our housing prices. I'm getting worried here on housing. DHI up 1.47, Lennar up 0.32. Pulte Homes up 1.1%. Toll Brothers 3.35%. KB Homes did pull back. Hovnanian another 12% over the week. Just on fire. By the way, almost all of these are hitting 52-week highs every single week. You look at the 52-week high list and you're going to find home builders. The XHB up 1.2%. Of all the puts I've sold as of May, none of them were assigned. And I opened up 2-week puts on DHI, Lennar, and XHB. These stocks are now sitting so far above their 200-day moving average. And almost every day on Bloomberg, I hear somebody talking about, well, where would you position yourself right now? Everyone's saying home builders, home builders, home builders. I'm beginning to think that it's become an extremely crowded trade. It's the correct trade when you consider the shortage of housing that the U.S. already has. Add to that the probably a high level of unwillingness of homeowners with a 3% mortgage to even consider selling their home and getting into a 6.5% mortgage. Unless they really have to, they're not gonna. You're going to have this housing shortage for quite some time, so the home builders are natural beneficiaries. But at some point, you have to look at the price and say, look, it's become very crowded and it's all priced in. That these price targets are price targets I would have thought a year from now or 2 years from now. When I was looking at DHI in the 70s under $80, I was thinking, well, I can hold this. I can get a nice 40-50% return over the next couple of years. Well, you already got it. And you have to think, well, can it go higher? Everybody's on the same page on home building. I don't hear anyone saying I wouldn't touch home building right now. Everyone's on the same page with the home builders. So that makes me a little bit concerned that, maybe I should wait for a pullback because, and I don't like technicals, but from a technical perspective, these things are extremely overextended. And if you look at different technical indicators for overbought conditions, almost every single technical indicator is suggesting an overbought position. Now, I don't buy into that stuff, but I know a lot of people buy into that stuff. Well, I shouldn't say a lot. There's a group of people in a lot of different places that buy into that stuff. And there are asset managers that include a technical synopsis along with the fundamental synopsis when looking at a stock. And I don't know that anyone would disagree that these things have run a lot. And that maybe a lot is priced in. So I am getting a little bit concerned about the pricing on the housing, but I'm not concerned that it's the wrong sector to be in. I kept waiting for a pullback and it never happened. It just kept moving and moving and moving. So maybe after these expire, I may decide to wait a little bit to see if there's a pullback and then time the selling of my, rather than having every 2 weeks at a specific time, sell 30 deltas, just wait and on a day where there's weakness, sell some 30 deltas. I don't know. I'm going to have to let it play out, but as I watch it every week going higher and higher, you get more and more uncomfortable that, well, what if I do get them assigned here? This far above the 200-day, you're probably, just to get back to the 200-day without any pain, you'd have to go sideways for at least a quarter and a half. Don't know that I want to do that. Mortgage apps down 5.7% for the week ending May 12th. Refinances and purchase index both down. This was really interesting. The housing market index hit 50. From 45. It had been under 50 for a long time. I think almost 12 months, 11 months, 12 months. Now back at 50. 50 meaning no expansion, but no more contraction. Anything under 50 is contraction. So that was a big jump up, going from 45 to 50. Building permits for April were down 1.5%. Housing starts up 2.2%. Existing home sales down 3.4%. Well, existing home sales have mortgages on them, and they're not going to sell them. I expect this trend here will probably continue. New home sales will probably be positive. We're going to get that on Tuesday. New home sales will probably be positive. Existing home sales will probably be negative. And that's more of a function of where the mortgage rate is the home owner does not want to be a home seller, and the home buyer is saying, well, if existing home sales are not hitting the market, I have to buy a new home, and maybe that's what continues to support the home builders. But it becomes, at a certain point, it becomes uncomfortable buying. If a stock has shown a history of reverting to its 200-day moving average over time, and when you're 2 to 3 standard deviations above your 200-day moving average, getting a little questionable. Tuesday, new home sales. Thursday, pending home sales. Okay, I'm going to show you a nice little site that I found. This is greenstreet.com. They have a commercial property price index. This is from May 4th. The data from April. Commercial property prices down 15% versus last year, which doesn't sound like a lot until we see how they construct their index. And let's just go down to the descriptions here. Institutional quality. The index is based on Green Street's frequently updated estimates of price appreciation of the property portfolios owned by the REITs in its U.S. coverage universe. Since REITs own high-quality properties, the index measures the value of institutional quality commercial real estate. And value-weighted. We place more weight on high-quality properties. For example, a New York skyscraper has a much greater impact than a suburban strip mall. Because our CPPI is value-weighted, it measures what's happening to real estate prices in aggregate, similar to the Wilshire 5000 that measures what's happening in the stock market in aggregate. Most property indices are equally weighted. So when you value-weight them and you lean them towards the highest quality properties, and you're seeing in the past 12 months that is down 15%. What do you think secondary properties are? So you have primary and you have secondary assets. Primary are gateway city properties like New York, Chicago, LA, and a lot of trophy properties as well, as I described previously, might be in some REITs. Boston Properties, for example, has a whole bunch of gateway properties. And we can see where their valuation has gone to. 15% on the highest quality commercial real estate in the last year. If you click download CPPI report, you get this report here. This chart here I think is interesting. The index level, it has an index value here. 100 is 2007. And this is the past month. We can see the decreases in the past month. And this is the past 12 months. Look at office, down 25%. And being down 25% as a category places it at 15% below 2007 prices. Malls, the retail has had a problem for a very long time. There were way too many malls, and they are disappearing slowly. You could still get rid of more malls, down 15%, sitting at 79% of what they were valued at in 2007. Apartments down 21. I found that rather surprising that they would be down that much. But when you look at the index value, they're still 50% valued 50% higher than they were in 2007. And now that I think about the quarterly reports that I've been through over the last year, the decision to exit all of the REITs, there were a lot of fair value, especially under IFSR, a lot of fair value write-downs. So the Canadian REITs, which follow IFSR, had fair value markdowns on their asset portfolio, so that their net income didn't look that great. You had to look at, to ignore net income and just pay attention to their net operating growth. But these are some pretty hefty negative amounts, and again, we're dealing with the highest quality properties. Now, if we think that you're going to have a discount rate that is higher for longer and in a lower growth environment, if you're incorporating cap rates, your cap rate is R minus G, R being the cost of that equity, G being the growth rate that you expect to get. Even if you don't change G, you're going to have to increase R, which means those cap rates are going to have to increase, which lowers the value of that property. If you lower the value of the property, you are increasing leverage automatically because the debt does not change. The value of the debt stays the same. So if you have a property valued at $100 million with 50% debt, and let's say that property drops 20% in value, you're down to $80 million on $50 million debt. You've just increased your leverage. And if you've increased your leverage, the cost of equity must go up the higher the leverage goes automatically, even without an increase in rates. Now add an increase in rates with an increase in leverage because the property value is decreasing. It's just not a sector, I think, that is priced to reflect that yet, with an IYR sitting over $80 and not wanting to, I guess, get the message that, listen, these rates are going to have to be higher for longer. Okay, retail sales. This is Table 2, estimated change in monthly sales for retail and food services. So here is the total, excluding motor vehicle and parts and gasoline stations, 0.6. The headline was 0.4. Let's look at where the negative numbers are for the month. Furniture and home furniture stores. That has been, the number in brackets is how many months in a row it's been negative. 3 months in a row. Electronics and appliance stores, 3 months in a row. You've got food and beverage and grocery stores are negative here. Gasoline stations are negative. That's been 6 months in a row. That's actually quite good. If you look at the year over year, it's down 14.6%. However, this is something you can look at in CPI. CPI is down 12% over that period of time. This is down 14.6%. So you can actually make the distinction here that quantity is dropping. Clothing and clothing accessories down 0.3, down 2.3% over the year. Sporting goods, hobby, musical instruments, books down 3.3%. That's been 3 months running. And general merchandise stores down 1.1. For sporting goods, I mean, that's a big drop right there. Foot Locker seemed to have confirmed that with their earnings last week. When we look at building material, garden equipment and supply dealers, Home Depot sits there. They lowered their revenue guidance for the year 3.5%. That is in line with what we're seeing here. It's sort of confirming that that trend is expected to continue. Target, for the general merchandise stores, Target, they in their call, they noticed that sales slowed in April from March in the discretionary category. The interesting thing comes in looking at the non-seasonally adjusted. Now, normally you'd look at seasonally adjusted because you do have to take out a lot of the variations from month to month because Easter falls in April. You have to sort of control for these seasonal effects because that's a big buying event. But if you look at the non-seasonally adjusted, it was down 2.4%. That's not annualized. That is not annualized. That is 1 month. And if you dig into the numbers a bit more, it is the worst April in the last 5 years if you take out 2020, which you would have to because everything shut down, what is it, March 19th, March 20th in 2020. So April was a write-off, really. Worst in 5 years on a non-seasonally adjusted basis. The categories that you're negative in are categories that you would expect, more durable discretionary items, and Target is saying the same thing. We've seen it slow down even more in April for the discretionary category. So while the headline number came in, I think, better than expected, or I think in line or as expected, showing, hey, the consumer is okay. When you dig underneath it, it's when you remove the seasonality. And I guess there is some argument to removing the seasonality because it seems to have been all messed up over the past couple of years, that maybe the seasonal numbers, are masking something else. Maybe you need better adjustments for the seasonality, or you just need to get past 2020 by at least 2-3 years. So maybe in 2027 the seasonality will be back in line and might be more reliable. Maybe peaking at the non-seasonal number might make sense, but for retail sales there is a lot of variation from month to month that is in fact seasonal. So sometimes you could see a drop from one month to another, and that drop has always been there. Like, you naturally would expect retail sales in January to be lower than retail sales in December. And if you didn't seasonally adjust, every January you would say, oh my God, the consumer's falling off a cliff. Look at the drop. Look at the drop. You would never do that. So whenever you have a month that has a holiday versus a month that doesn't have a holiday, you have to take that into consideration. Although I will say, for April having Easter on a non-seasonally adjusted basis to be 2.4% lower than the March, unless a whole bunch of Easter shopping was done in March. That could have been because Easter was early in April. Okay, well, maybe, you could look at that and say, well, because it was earlier in April than the year before, if it was earlier in April, maybe a lot of the Easter shopping was loaded into March, right? So you see the dilemma you have here in thinking about, well, where could the shopping have happened? If Easter shows up in the first weekend in April, then most of the buying was done in March. Then not seasonally adjusting would make it look like there was a big drop, but as soon as you seasonally adjusted, right? So it's, but what if the seasonal adjustment is not reliable because of the variability, the extreme variability you've had over the last couple of years, and it's trying to incorporate that data. So it's hard to get a good reading on this. I think the best readings are listening to companies. Home Depot lowered their revenue guidance. Foot Locker did not do well. Target noticing a slowdown in sales. Another data point last week, the leading indicators from the conference board declined 0.6% in April to 107.5, following a decline of 1.2 in March. LEI is down 4.4% over the 6-month period between October and April, a steeper rate of decline than its 3.8% contraction over the previous 6 months. And here we are, way down here in terms of year-over-year change in the LEI. If you look at the components of it, the index of stock prices, look at that. Everything else here negative, but the S&P is saying, we're looking past this. We're looking past this. Manufacturers' new orders, consumer goods and materials eked out a small gain, 0.09. You could almost say that's unchanged, but every other index, these are the financial components up here. These are the non-financial components. You can see the tag on each of these. The non-financial components are all negative. It is. I think we have another chart here. The blue line is the 6-month rate. The black line is a warning. When it gets close to the negative 4%, it flashes a warning. When it breaks down, it flashes a recession signal. And it's always had a recession, and we're being in recession signal territory for some time. Let's take a trip north of the border to Canada. And Tuesday, CPI was released. Look at some of these numbers here. Inflation rate month over month, 0.7%. Forecast was for 0.4. Previous was 0.5. So it was expecting a step down. Instead, it got a significant step up. Year over year, 4.4. Previous was 4.3, expecting 4.1. Again, we were expecting a step down and got a step up instead. The core inflation rate for April month over month was 0.5. Previous was 0.6. So there's your step down. However, that is still 6.16% annualized. The Bank of Canada Governor, Tiff Macklem, that's right, his name is Tiff. Let me write it out for you. Tiff Macklem was in Argentina, and he said it is far too early to be thinking about interest rate cuts. Scotiabank chief economist thinks it is appropriate and probably needed that the central bank increase rates 25 basis points in June. June 7th is their next meeting. That's 17 days away. Canadian Real Estate Association. Let's look at some housing stats. This is incredible. Home sales for April up 11.3%. This is a killer. April, if we look at housing prices, up 100,000. The average home price up 100,000 just since January. There was a story in Globe and Mail a while back about the Toronto, I think it was Globe and Mail, about the Toronto real estate market, saying bidding wars are back. Bidding wars are back. So housing is going right back up. So if we're thinking about core services X housing on the Canadian side, that's not going to work out too well. Average home prices up over, actually the article said over 100, or the news release said over 100,000, but I'm just going to say up 100,000 just since January, right? And you're starting to see that show up in some of these numbers here. The pair, the US CAD pair, was down 0.418% for the week because the US is the first in the pair. That is the US's performance relative to the Canadian. The US has dropped 0.418% versus the Canadian. You don't get a lot of implied volatility in currencies. This is, implied volatility is 15%. IV last was 6%. The IVP, that's your percentile, right? It's in the 15th percentile, but IV itself is only 6%. You don't get a lot of volatility in this pair. To sell puts on this, you have to invert it. To know where you want to sell your puts. So I did sell puts. So take the closing price, 1.3503. If you invert that, you get to 0.74057. You'll notice the red line up here. You see this line across here, the shading. That means that I am short the pair, which means I'm long the Canadian. There is my average price on my short. So it's in the money. The short position is in the money right now. 0.74057 is the inversion, so I sold the 0.745 puts. It has a delta of 0.565 because I do expect that this will move up, and when this moves up, it means that this moves down, which means the movement on this chart is downwards. If we look at where it's been having trouble, right around 132.5 to 133. It just seems to bounce along there. But if we think about it in terms of the top part, you do have a declining trend here. So the further out it goes, the more it gets squeezed. It's more likely to break down to the downside. A couple of things going in Canada's favor, I think, is as we have more and more discussion about rare earth minerals, as more and more discussion about mining and materials, and especially about copper. Canada's got a lot of that stuff. So that is beneficial for Canada. And if we also have a lot of inflation, because we have a lot of immigration, and those immigrants have to find their place somewhere, they have to find housing, and look what's going on, right? You're going to have to raise those rates even higher, which puts Canada in, I guess, the advantage in terms of interest rate differentials, because if the belief is that the Fed is on hold, and the belief is that the Bank of Canada has to move further, well, then that is only going to support the Canadian dollar. So I have sold puts on the Canadian at 0.745, and this is for the July expiration. It's usually the first week of each month that the options expire, and the options are on the futures. So you have to look at the futures price and the options on the futures price. I'm just looking at the spot price, finding a strike at which I'm comfortable with, as opposed, because the spot will converge to the futures price by that point in time. So why not just look past the futures price? Why do I not buy the futures? Why do I not just do that? Because I get negative carry, and I don't want the negative carry. So by selling puts, I can avoid that, and that's where I am on the Canadian. I think it might be, I don't know, but it might be something the Fed may look at and say, hey, listen, the guys to the north, they went on pause, and their last inflation read really wasn't that great. Why don't we just go one more 25 just to really make sure about this, because they're going to see what the Bank of Canada is going to do on June 7th. And if the Bank of Canada raises 25 basis points on June 7th, I think that reasoning is going to find its way into the committee and say, do we want to be this? Do we want to be this stop and go thing? Canada just stopped and now they had to go. Do we want that going on as well? I don't know if that enters into their thinking. I know in reading the minutes, they do mention what other central banks are doing ever so slightly, but they do give a nod to it. So I don't really know if they actually would look at that situation and say, hey, there's a real world test. They went on pause. They're right beside us. This is what happened to them. We'll see. All right, let's get to beta. The SPX was not a good week for being short beta. And you know I am net short beta. Was not a good week for being net long duration. And as you know, I am net long duration. So both of these failed. When I look back on the week to see what the event was, there are two possibilities. When Biden was speaking, he was speaking earlier in the week, he did make a statement along these lines. Both sides have agreed that we're not going to default on our debt. We don't have a deal. We don't know what the deal looks like, but we're not going to default on our debt. And that was all the market needed to hear. And it went straight up on those words. I know it did because as I was listening to him saying it, I'm looking at my other screen and there were green bars printed on the screen and it just kept on going. And that's all that mattered is, oh, well, it'll all be taken care of. Till later in the day on Friday when there was some concern of whether it will or whether it won't. And we saw Friday after the market closed, a couple hours after, that negotiations had broken off and Republicans saying this wasn't a negotiation. We're too far apart. Saturday, there was some thought that they'd get back at it, and then that didn't work out. And then Sunday, the latest information I have is Biden saying Republicans they're not moving on anything, and it's unacceptable. We can't, we're not going to accept that. But that he would be speaking with McCarthy later that afternoon, and maybe that'll take care of something. I don't know. On that one, but the market seems unconcerned overall with it. If you look at where implied volatility ended on Friday, 13.5, that's extremely low. I've said, let me tell you about the second event. It could have been what Biden said, or it could have been the event that happened last Sunday, and this didn't make the news anywhere. I was in the backyard, and I had my backyard redone. There's no grass. It's a lot of pavers, like a stone in the backyard. And I dropped my coffee mug. Coffee mug I've had for, I think, almost 20 years now, my favorite coffee mug, and it broke. I knew that wasn't a good sign right then and there, and no one picked it up. Didn't Reuters, nothing. Barron's, nothing. Wall Street Journal, nothing. And I knew that wasn't a good omen. It wasn't a good omen. So it could have been me, or it could have been Biden. I don't know. Toss a coin. One thing I will say, and I've said this before about the asymmetry of information and how the market incorporates information. So Biden says, a politician, says that both parties have agreed there'll be no default, but we don't know what a deal looks like. And that was enough. Just some hope. If you give the market some hope, it will rally. But if you threaten the market with something, the market sort of responds with, well, let's see. Let's see what happens. Show me the bad news. But you don't have to show it the good news. You just have to whisper the good news to it. Hey, look over there on the hill. There's a glimmer of hope. Okay, well, let's climb that hill. But if you say, on the way there's a whole bunch of alligators. Somebody will move the alligators, though, right? Somebody will move the alligators will move on their own, won't they? It's sort of like, when you were at the circus and there's one clown running around with a pie and there's another clown standing there not seeing what's going on. That's the market. Is the pie actually has to hit the clown in the face before the market responds. And if you're at the circus, when the pie finally hits the clown's face, there's the big audience reaction like, wow, that was unexpected. No one saw that coming. And that's exactly what has to happen here is bad news actually has to show up. It actually has to happen. But good news All you need is hope. All you need is hope, and off you go. So if you are short, you must be tactical. You have to play it tactically. And I have been playing it tactically ever since I have been short. So yeah, my open positions didn't work out too well, but when I think of all of the tactical gains that I've made over time, my break even is still in the upper 4,200, so I'm still okay. Just not happy. Four quarter EPS 222.35. You call that unchanged from the last number we had, 222.72. SPX closing 41.91 puts it as almost 19 times forward earnings, 18.85. The inverse of the PE earnings yield, 5.3, 10 years 3.7, 160 basis points between the two, which is down from last week. No volatility showing up at all. 13-week percentile. We're in the 5th percentile. In the 1st percentile over the last year. Friday was options expiration, and I wanted to accumulate some stock, so I allowed some things to be assigned to me. FCX I've got shares of. COPX were assigned. I have more Alcoa and more GM. I engineered them in such a way that I wanted them put to me anyways. I wasn't going to roll them forward. Some options I rolled forward that were in gains anyways. Anything that wasn't in a gain, that was negative, I didn't roll them forward because I said, I want these anyways. That was the whole point of selling the put, is I wanted to get them at a lower price, and I got them. I've sold 30 Delta puts going into June, 30 to 50 Delta puts, COPX, FCX, Rio, XHB, DHI, Lennar, ZB, which is the 30-year bond futures contract. I think I did that one for... I think the underlying on it was the September bond. Oxy sold more there. The CAT I already told you about. Deere really gets me. I mean, they had great earnings, not just great earnings. If you look at year over year, talk about blowing it away. They blew it away on both revenues, on both earnings, and they raised their guidance for the full year. Raised their guidance. And they sold off because the belief is, oh, well, this is the best it's going to be. It can't get any better from here. And it started selling off. I took that opportunity to say, I'll take it. I'll take the puts on that. Tyson Foods, having trouble with meat, with the proteins, beef, chicken, and pork. And they're cutting 10% of the workforce. They're shutting down 2 poultry processing plants. They're just having some trouble there. Well, those things aren't going away. This is not a matter of technology obsoleting something. This is not ChatGPT making Chegg obsolete. Those things are not going away. So those things will come back. And right now they are at multi-year lows. If you look at a long-term chart of Tyson, they're in this is basically a value play. So I don't mind selling puts on this one, because if it is put to me, it'll be put to me at the lower price minus the premium. I don't mind holding on to that one. So I've sold puts on Tyson. KRE, I sold 70 puts with a 30 delta. I was avoiding this one altogether because you still have a lot of commercial real estate that has to work its way through the regional banks. But I think that the crisis for them is over. Okay, so this has got to work its way through. My thinking is, well, that's operational. You're probably going to have a hit on earnings somewhere. But given how the KRE has cratered from where it used to be, it's probably trading below what price it would be with operational difficulties. That maybe this lower price is still some fear that whatever's going on there is not over. But they do have the ability now to bring their collateral to the Fed and get and borrow at par. So I don't know that they have a liquidity problem anymore. They may have a looming credit problem, but not a liquidity problem. And I think the pricing of that index massively reflects a liquidity issue from given the drop that it's had, and is probably still concerned about a credit issue. But if you remove the liquidity issue and you just add the credit issue of commercial real estate, that index would have dropped anyways. But would it have dropped to the point where it is now? Hard to say. But I'm willing to take a little bit of a bet on it. And again, I wasn't gonna. I was just looking at it on Friday. I thought, well, let's just dip our toe in. You know, it is an index. It's not like I would never do this on a particular bank. On any one particular bank, I wouldn't do that because you're taking on way too much idiosyncratic risk. But it is an index. So, okay, let's take a position. I sold 70 puts at 30 delta. This is purely speculative, by the way. It's purely speculative. So don't copy me on this one. I am not advocating for this at all. I'm just saying, you know, what's the downside here? So I got to hold on to it for a while. I'm going to get it at a price cheaper than where the market is right now. And because it has liquid options, I always know how to work my way out of a problem anyways. And for me, it's a small position. It's purely speculative. That's all it is. I'm basically here flipping a coin and hoping it works out. If it doesn't, well, I know how to roll puts. I know how to add the underlying. I know how to work my way out of a problem. You know, the best way to avoid to get out of a problem is to avoid a problem. I get that. I'm probably walking into a problem, but walking into this room, I know where all the exits are. So it's not as if I'm walking into a trap where I'm just going to take a loss. I can work my way out of this. If you don't know how to do that, then don't do it. I want to stress this is purely speculative on this one that I'm doing. All right, let's spend some time with the elephant in the room. This rally that we've had in the last week. And on Friday Friday morning, pushed above 4,200. The SPX was above 4,200 and appeared to want to go higher in front of Jerome Powell's 11 o'clock discussion. The market just didn't see, and I've seen instances of that before where the market rallies before a key report, and that the market simply has just decided it doesn't care what the report says. It doesn't care. We're going higher. So I thought here we are again. We're going to end the week doing this. And we're over 4,200 on SPX. That was a key barrier. Now that it's crossed, is this going to lead to a momentum run to 43? So being short, you start to get concerned. You start looking around and saying, well, I need to add some positive beta somewhere. And I'm not unwinding my beta position, but I will roll up. I have sold puts. I will roll up those puts. I decided I would wait to see what Powell had to say, and then I would respond. And we got a sell-off. And then it kind of rallied in the afternoon to 4, and then after 4, it lost about 10 points in the hour after 4. It kept going down. I don't know how we're going to open Monday. There is, I'm sure you've heard the breakdown and the analysis of the rally since January, that it's really coming, that 80% of this is really coming from those big cap mega tech, the tech mega cap companies, Apple, Meta, companies like that. That if you remove them, that there really hasn't been that kind of rally. The index isn't up 10% since the beginning of the year if you remove them. And of those, the ones that mention AI the most seem to have had the biggest price increases. In fact, it's almost guaranteed that if you mention AI in your earnings call, you can avoid a lot of the negative reaction that might have come from your earnings. Bank of America has described AI now as a mini bubble. Not a real bubble, but a mini bubble. And one thing I've learned over the years is you never short momentum. You just get out of its way. And if that is what's going to show up here, if more and more companies start embracing AI and talking about AI, and AI is going to do this for us and that for us. You know, I remember the dot-com era. I was around. You know, look in the morning and the stock is 125. You come back later in the afternoon, it's 210. I'm not kidding you. It was that ridiculous. It was that ridiculous that you're looking at some stocks going up $50 in a day, $60, $70, $80, and you can only look at that for so long before it starts drawing your money into the market as well. Well, could AI be doing this? I mean, everyone, I think, can recognize what AI can do. It is like the internet. It is one of those profound technologies that you can imagine the change that would happen. Well, a lot of it was overhyped with the .com. It didn't replace all the stores and all the malls, but it did have an effect. It did find its way into people's lives. AI is sort of the same thing. You can imagine all sorts of applications for it. So there's a lot of hype right now. Could that be enough to propel the market higher? It could be. It could be. And if it is going to go higher, you certainly don't want to be in the way of that. So now I have to decide what I want to do with my short beta position. On Friday morning, the index, SPX, broke 4,200. It was a 4,215, 4,216 at one point. And this is before Powell spoke. And I thought, I've seen this sort of thing before where the market in front of a key report just starts rallying to the point where, the market is sending the signal that we don't care what the report says. We don't care. It wouldn't matter what the report was anymore. We're going higher. And it worked out that way. Even if the report came out negative, the market just kept going. And I thought this is going to be one of those things that even if Powell says we're going up another 200 basis points, maybe this market just keeps rallying based on AI. But then it sold off. It started to get the message again. Some rationality came in. So the bubblicious part of it hasn't really gotten a hold yet. So I didn't do anything. I wanted to wait for Powell to speak before I made any kind of decision. The market sold off. So what I did at that time is I sold 4180 puts on the market. I sold 4180 puts. And this is to get my average cost higher. If we continue down from here, I don't lose on those puts because they would offset some other long positions I have anyways. All I've done is I've lowered the amount of upside that I can get. If the market drops 200 points, well, I don't get the same upside I would have gotten, but if the market rallies, well, then I don't suffer the same upside. I don't know what to do right now because the market did sell off on Friday. Rationality seemed to have gotten a hold of the market in terms of where the cost of capital should be. It did try to claw its way back to the zero line by 4 o'clock, but after 4 it continued in the red, dropped another 8 or 9 points in the last hour. You have no resolution on the debt ceiling. Globex opens at 6 o'clock. Nothing is going on right now. I don't know what to expect on Monday. I'm going to let the market tell me what I want to do. Nice thing about Globex is I can do a whole bunch of risk management while everybody has to wait till 9:30 because the futures trade and the options on the futures trade as well. So I can find ways to minimize whatever impact there is, but I don't know how the market's going to open, so I don't know what I'm going to do. I know we have 3 Fed speakers on Monday, so my inclination is to wait to see, because I know they're going to fire bullets at the market. I know they will. My inclination is to wait and see if the market drops to its knees on those bullets or if it just takes those bullets in the chest and keeps going up the hill. If it does, then I am going to roll up my puts aggressively, and I'm going to keep rolling up my puts. I know how to work my way out of trouble, so I'm not too concerned about it. I'd rather not give up the upside because I got this strange feeling that as soon as I roll up my puts and hedge out any upside risk, the market will just turn and go down 300 points and say, we always wanted to go down. It's just you've had a good year. Enough. I do trace this back to my coffee cup, though. I do think that had a significant effect on what happened this last week. Also, the microwave that I bought for under the counter doesn't open in on itself; it opens out, so it hits the side cabinet. So I had to take it back. That was my coffee cup as well. Just to cap off the week, the kitchen is now on hold because the microwave didn't fit. So I had to go order a new microwave that opens in on itself. You'd think that would be easy to do, but it doesn't. When I say opens in on itself, it means that the door, when you open the door doesn't do this. It curves in on itself so that some of you might know what I'm talking about. But now I have to wait 2 to 4 weeks to get a microwave, all because of one coffee cup. Let's look at our economic calendar. There's your 3 speakers early on Monday morning, Victoria Day in Canada. So we are closed, so I don't have to worry about any Canadian risk. You have your 3 speakers. By 11 o'clock, I'll pretty much know what I want to do. We'll see if any good news broke out over the weekend or from here until the opening, and depending on what the feeling is by Monday at 11, I'll know what I want to do at that point in time. But again, my inclination is, no matter what I see tonight, is just to wait until this happens. And if this doesn't have an effect, then I'm going to have to start moving towards a more neutral position. Going into Tuesday, you still have another Fed speaker up at 9. You have the S&P PMIs that come out. There's new home sales there. Some of the regional banks are reporting their indexes. Richmond Fed is here. Let's see. Let's keep going. Not much going on here. There's a big risk event here. 2 o'clock is the FOMC meeting. The market tends to move on it right away. But you got to get the thing, and then you got to start reading it. It usually takes about 15 to 20 minutes to get, at least a rough idea of what was being said, and if it changes anything. How does the market move right away? How does the market know? It's because you have individuals who have early access to it that are sequestered. In other words, they can see it, but they can't communicate with anybody. They can't do anything because nothing gets released till 2. They're typically journalists. That have early access to it. And then at 2 o'clock, they can then release their stories, they can release their statements. So a lot of that is paid attention to first. The algorithms pick up on those stories that are released first, and then they tend to move based on either positive or negative remarks in those particular stories. So there is a bit of an advantage for some people on that one. Going into May 25th, you're going to get GDP. This is the second look at Q1 GDP. The forecast is 1.1, which is where it was last time. There are usually revisions, small ones up or down, but we're going to get a second look at that. And you have continuing jobless claims. Initial jobless claims, continuous jobless claims. Initial jobless claims, forecast 250, sitting around the mid-2s. As long as you're staying there, that is still consistent with job growth. Looking at what the initial jobless claims were this month, I can't see how the May jobs report, which we get the first Friday of June, not this Friday, but next Friday, isn't going to show job growth as well. Pending home sales, there is Collins speaking. There's the Kansas City composite. And there's your big one for the week. Friday is the PCE report. That can move the market. Personal income, personal spending. And then at 10, you have Michigan consumer sentiment. It fell last Friday. If you recall, last Friday, that was a negative event in terms of market pricing. It did react to that very quickly. It basically reacted to the inflation expectation component. So we'll see what it does this week. Let's look at earnings. This week, we continue on with some of the retailers: Nordstrom, AutoZone, Lowe's. Let's see if Lowe's follows suit with Home Depot. Best Buy, Dollar Tree. You have Ralph Lauren and Costco finishing up on Thursday. For technology here, I think your big one is Wednesday after the close, NVIDIA. This is an AI story. This is, if you think about a gold rush. Do you want to open a gold mine, or do you want to sell picks and shovels? The The sellers of all the material for the gold miners in the California gold rush made more money than any of the individual gold miners did. And that's what NVIDIA does. They sell these chips, which I find rather odd, because this story seems to have a major contradiction in it. NVIDIA sells the chips, and I think their stock price from the beginning of the year is, what is it, over 100% or something like that? Last I heard, over 100%. I don't follow it. And, because they sell, well, if AI is going to be this thing, you're going to need more computing power, significantly more computing power, so here are the chips. Yet, when you look at Microsoft's report, and you look at their investment, their fixed investment year over year, they went from 17 billion down to 3 billion. Same with Facebook. Google. Google dropped their investment in fixed assets. They also increased the useful life of their servers, saying it's not 4 years, it's 6 years. We don't need new servers. So it seems odd to me that if AI needs more computing power, which means more chips, and everyone's buying NVIDIA, but you had two very large companies, I can't remember the second one, I think Microsoft did the same thing as Google, said our servers are 6 years, not 4 years. In fact, a lot of IT companies, large IT companies, have already done that, extended the useful life of their servers. If AI is going to take more computing power, why are companies that are basically in the midst of AI, Google, Microsoft, extending the useful life of their servers and decreasing their investment in assets? So if you look at cash flow from investing, it's way down year over year, and our servers are going to last forever. Yet NVIDIA price keeps going up because, well, you're going to have to buy more chips. One of those two stories has to be wrong. I'm not sure which one it is. But it seems rather odd to me that you have that going on. Anyways, we'll see what NVIDIA has to say on this one. And that will wrap it up for this week.